What's up everyone, it's Caddy with Money Vesting. So in this video, we are going to be talking about the housing market, which I haven't really done a specific detailed video on. I've been getting a lot of questions about this market. In fact, we do also have specific channels dedicated to the real estate market in our Discord. But I wanted to go over some of the signs, some of the indicators, some of the reports that I think are going to be very, very important in our understanding of where the real estate market, or in other words, the housing market is headed in 2023 and how this could actually lead to a potential recession this year as well. So hope you guys enjoy this video and find it helpful. If you do, don't forget to subscribe to the channel if you're just joining us for the first time, and the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, you'll get access to all the alerts, buy and sell alerts, options alerts, trade ideas, and private videos in our Patreon and Discord as well. The link's going to be down below. It's the first week of the month, usually the best time to join. So we already know that housing market's been on fire. It's been pushing higher. We've seen the real estate prices pretty much rally all the way up. On a 10-year annualized basis, they're up a little bit over 7.43%. This right here is going to be in the last 1 year alone. In fact, we did get the Case-Shiller Home Price Index that did suggest that prices were up 5.76% in December of 2022 versus same time last year. So we have seen a pretty consistent, pretty stable move. And of course, after the pandemic, with so much liquidity injected in the US economy, with so much stimulus and the quantitative easing from the Federal Reserve, with the rates dropping as low as under 1.5%, I also know some buyers who've got it locked at under 2% for 30 years fixed. That's some incredible rates. Real estate prices were bound to go higher, and they did 11.5% on an annualized basis for the last 3 years. Those are some pretty substantial gains, definitely outperforming the markets on an annualized basis. And now we're getting into a situation where mortgage rates are once again pushing higher. So that's what we're here to discuss, and how this is going to actually affect the housing market moving forward, because there's a lot of lenders out there, 30-year fixed, they're now creeping up to 6.5, 7.125%. And I want to talk a little bit about how this can affect the housing market moving forward, because there is a significant lag with which the housing market, in other words, the real estate market, gets affected with higher interest rates. It's not instantaneous, as opposed to what many people might believe. It's not as if, rates go higher and immediately we see the prices come down. No, there is a lag. And I'm actually going to go over a paper, a research study done by the Bank of International Settlements that talked about this specific phenomenon with respect to the lag and interest rates, real estate lags and interest rates. But because mortgage rates are pushing higher, we have, again, this is going over for 2022, 5.8% price gain was the 15th best performance in the index's 35-year history, but was well below 2021's record-setting 18.9%. So once again, if you analyze those numbers along with the 2020 gain, we're looking at 11.5% on an annualized basis. And the annual increase for the 10-city composite, which includes New York, Los Angeles metro areas, was 4.4% in December, down from 6.3% in the previous month. So we're definitely starting to see a little bit of a pullback in prices, and I'm going to discuss that in more detail. But if you take a look at quarter to date, prices are down close to 2% on an aggregate basis. Of course, some markets are down more. Some markets are actually higher, but on an aggregate basis, we are down a little bit close to 1.95% for quarter to date. And moving forward, as interest rates go higher, this is a very quick representation of how that's actually going to be affecting your monthly mortgage payment, right? For the same house, same loan, same, everything same. And I'm not even including, HOA. So I'm not including homeowners association fees. I'm not including property taxes, not including, PMI if you have that, not including any of that. Simply taking into account the principal and the interest payments if the rate is higher. So right now, since we're sitting at well over 7% on a 30-year fix, if we go with a 7.14% interest rate on mortgages with a $500,000 home, the actual total payment at the end of the 30 years, in other words, 360 months, is going to be close to $1 million for that home. Or in other words, $569,000 extra, which is more than the principal that you'd be paying for that home. Compare this to when interest rates were as low as 4%, that number was only $287,000 more in interest and a total payment of $687,000. And what's really interesting here is that the monthly payment as well has gone up substantially over the last few months. It's gone up to almost $2,700, and this is not even including your property taxes, your homeowners association fees, or your insurance. None of that, right? So it's not even including those things, only including interest and principal. $2,700 versus $1,900, which was at 4% for the same house, same home price, same financing. So you're putting down about $100,000, which is 20%. So you can see the vast difference in not only your monthly payment, but the overall payment in general. And what's the end result? Well, you're starting to see the purchase index, which pretty much includes new home purchases only, the applications that people are filing for new home purchases in the United States, fall to its lowest level since 1995, right? So that's the lowest levels that we have seen in over 25, almost 30 years here. And this number obviously dropping off pretty substantially. Of course, back in 2007, 2008, we saw that level come down to this right here, 200, closer to 250s. And now we're sitting at 150. If you go back, this is the last levels we've seen back in 1995. This right here is going to be MBA mortgage application survey covering both purchases and refinance applications for the past 3 months. We're starting to see a decline here. So we are seeing significant declines in the amount of applications being put forth for refinancing and for purchases. But this right here definitely is a very, very telling index in itself that, people, average consumers and homeowners are definitely reluctant in going into the market, buying homes right now, considering interest rates are higher, monthly payments are higher, home prices are really exuberant, still going higher. And as a result, we're seeing new home purchase applications fall to its lowest level in 25 to 30 years. Now, there are delinquency rates, which are still pretty low. So there's definitely an argument to be made in the favor of a very strong real estate market, because despite higher mortgage rates, despite higher monthly payments, we're still seeing people able to pay for those because the delinquency rates are really, really low. In fact, in November 2022, we did see a decline for 30 days or more past due, down from 3.6% down to 2.9%, and 30 to 60 days past due, it did uptick a little bit from 1.2 to 1.4%, and 120 days past due, it ticked down from 1.6 to 0.9%, and foreclosure slightly increased from 0.2 to 0.3%. So they are relatively stable. But that's also because, in my opinion, that when we went over that research paper, which I'm going to go over now, it's a working paper from Bank of International Settlements, the average, and you can read that yourself. However, past changes in interest rates on average do affect real house price changes in expected direction. For instance, changes in interest rates lagged by 8 quarters in the United States, or by 2 years in non-US advanced economies. So 8 quarters, 4 quarters in a year, that's on average 2 years of a lag for real estate prices with respect to interest rates. So this is definitely a very, very, very slow moving market, which is going to take a significant time in order for it to play through to the entire economy. This right here is another part of that paper covering the United States specifically. So changes in U.S. house prices are highly persistent. And this was actually what made a lot of sense and was very, very interesting. And what they mentioned here is that all lags except 468 enter the regression with a positive sign, meaning that U.S. house prices tend to move in the same direction for about a year. Meaning as interest rates are going higher, they tend to move in the same direction for at least 1 year after being hit with a disturbance and then exhibiting a modest reversal. Again, modest being depending on how severe the interest rate hikes are, if they're very, very significant. So for example, if you go over to the mortgage rates over here, mortgage rates were sitting at roughly around 2.1% back in November of 2021. So literally about less than 2 years ago, we were sitting at 2.2%. Fast forward to June 2022, we were sitting at 4.2, 4.1%. And now obviously we're sitting at well over 7%. So it hasn't even been 2 years since we've come from 2% interest rates to over now 7% interest rates. And this paper obviously does suggest that the lag is on average of about 8 quarters. So moving forward, I would not be surprised if we actually do start to see a pullback in housing prices as people, it's really about how you make sense of buying versus renting, right? So, and I was also reading another report elsewhere, which pretty much suggested that most of the homes that are purchased are financed. Closer to 71% of homes purchased in the United States, buyers use some form of financing. Only 29% are paid with complete cash. So financing is obviously the main way with which, average households or consumers pretty much buy homes. And if that method or that financing options are becoming more and more expensive, obviously there's going to be talks about potentially renting, which creates more potential for shelter prices to go higher as demand floods over away from buying over to renting, which creates more problems for inflation in 2023. So bottom line is, I think we are closing in on that gap for that 2-year lag for the interest rates going higher with respect to the real estate market. And I would not be surprised personally moving forward in 2023 if this spring market for housing, we start to see a little bit of a pullback in overall aggregate prices as more and more of this report comes out. I mean, we're already down quarter to date, but I wouldn't be surprised that if in 2023 we do see housing prices overall on an aggregate basis start to pull back, which also may lead to potential recession in 2023, sometime in the middle or end of 2023. And I know not a lot of people are talking about recession anymore because everyone seems to have forgotten about all the other economic reports and data points that we're getting because of how much the markets have already pushed higher, but it is a real concern and it is something that we need to discuss. So hope you guys enjoyed this video and a complete update on the housing market. Just wanted to go over some of the indicators and some of the signs of the market that I'm actually definitely watching right now. Let me know your thoughts on the housing market as well, definitely down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Happy investing, and I'll see you all in the next video.